In this video, we examine the ratio of gold to treasuries to gain a better understanding of inflation expectations and what to look for in terms of signaling a probable lasting bottom in risk assets. We will close with some comments on European debt. What we've got here is the ratio of gold, the gold ETF, GLD, to longer-term U.S. treasuries, the symbol being TLT. Why are we looking at this? It can help us with precious metals, it can help us with commodities, it can help us with bonds, it can help us with stocks. So even if you're not interested in gold or treasuries, this is a good ratio to look at, and we should be able to learn some things from the ratio. Before we start, we're going to look at 2008, but it should be noted that the present day doesn't need to be similar to 2008 to get good signals from this ratio. Why? Well, this ratio is somewhat the ratio of inflation expectations, strong economic activity, which would be GLD, versus deflation expectations or a weakening economy, which would be TLT. So think of this as optimistic about the future, optimistic about inflation, and think of this as being pessimistic about the future and pessimistic about inflation and optimistic potentially about deflation. All right, what are we looking at here? This is a chart that starts in 2007 roughly, goes to 2009. You'll notice we had kind of a double top here in 2008. We've got a similar setup here in 2011. We broke down here and we went through this upward sloping trend line. So somewhat think of this trend line as inflation expectations are still increasing here, and this is when inflation expectations break down. You'll notice we also broke through an upward sloping trend line of inflation expectations right here in 2011. Now, somewhat of the key takeaways are, in 2008, we tried to rally, we came down, and we tried to rally back to this base, and we failed. If you look here, we came down, we tried to rally back to this base, and the jury's still out on whether or not we're going to fail, but these candlesticks tell you that last week was a strong week up. If you look at this candlestick, look how much white is in there. I know it's hard to see, but this has got a big body, so this is a big bullish move for inflation here in late 2008. This candlestick looks a little bit better than this one because there's a lot of indecision in this one. There's almost no indecision here. So we've got to give the bulls the benefit of the doubt here on this chart. However, this week we've dropped back, and when we failed here, what happened? This is the S&P 500. These are weekly charts that we're looking at. From this failure here, the S&P 500 dropped from 1223 eventually down to 666 was the intraday low. That's a 46% drop. If you look here, here's the similarity that's got us spooked here a little bit. If you look at this indicator, this is Williams percent R. It's basically a momentum indicator. Notice when the bear market was still going on, this indicator was hesitant and weak. Let's go through this right here. This is Williams percent R. It says the failure to move back into overbought or oversold territory signals a change in momentum. So overbought territory is above negative 20, and oversold territory is below negative 80. The ability to consistently move above negative 20 is a sign of strength. After all, it takes buying pressure to push percent R into overbought territory. Once a security shows strength by pushing into overbought territory more than once, so that would be overbought territory, overbought territory, overbought territory, a subsequent failure to exceed this level shows weakening momentum that can foreshadow a decline. So we've pushed into overbought territory more than once. Here we get a situation where we get a subsequent failure to get back into overbought territory. So this is weak. We weren't getting in here, and it says it can foreshadow a decline. So notice when we didn't get in here, it did foreshadow a decline. This ratio dropped precipitously from here. So did stocks. Gold from this point, which is the similar point that we're in now, dropped 17.3%. The GLD dropped from roughly 87 down to below 72. So if you look at this indecision here, we've got a similar situation here. This is a weak move, and the current move has failed. First of all, it overtook negative 50, and then we dropped below it. And thus far, it has failed to move above negative 20. Now, what we would be looking for here is, in the last bear market, when we were able to retake negative 20, which is a bullish signal, this really signaled that the bear market was almost over. This right here, we didn't have much further to go. We bottomed and we went up. So what we would be looking for is we'd like to see this Williams percent R on the ratio of gold to treasuries. So think inflation to deflation. You'd like to see this push up convincingly. And notice how convincing this move is here. This is a sharp spike into overbought territory with lots of green above. So we would like to see a sharp spike up here, which would be an indication that we're getting closer and closer to a bottom. Right now, the present day market really doesn't look very convincing here, and it looks more like this area where we had a failure. Stocks dropped a long, long way here. To put this in perspective from a risk-reward perspective, if the S&P 500 gained 46% from current levels, it would be over 1,800. It would literally go off this chart. I don't think anybody believes that the S&P 500 is heading towards 1,800 anytime soon, nor do we necessarily believe that the S&P 500 is going to drop 46% from here. But you'll notice how quickly we dropped here and came down lower. What it is telling us is, currently, as long as this chart looks like this, present day chart looks like this, the odds of a steep decline are still in play. And the odds of getting a huge run up, because even look at this, look how sharp this decline is here, and even when the bear market ended, you don't get a slope that looks similar to this. So from a risk-reward perspective, the odds of us getting something like this seem to be greater than getting something like this. When will that flip? It would flip if the present day chart can start to look like this. I want to point out that this text was taken from stockcharts.com. They do an outstanding job there. If you ever want to learn more about one of these indicators, just search on Google Williams percent R, just type this in and add stock charts at the end of it, and you can go to what they call Chart School. They have a wealth of excellent free information that I reference often, just like this. You go back and you read, and you just want to make sure that you're understanding what this is telling you. And it's always good to go back and look at your textbooks and your reference books and keep yourself fresh and up to date. A few more comments before we leave here, and then we're going to talk a little bit about bonds in Europe. Notice here, when we're getting close to the end of the bear market, we did get another failure here. So there's an attempt to break this trend line. The first one fails. The second one fails. But the way you've really got to look at this is the beginning of a new trend here. You've got a downward sloping trend line that's broken here. So visualize a trend line coming down here. Step one is you break the trend line. Come up here. Step two in a trend change is that you make a higher high. So this high, a higher low. This low is higher than this low. That's step two. Step three of a trend change, where you get kind of a confirmation that we have hit bullish territory, is when you exceed this high. So step one, you break a trend line. Step two, you make a higher low. This is higher than this. Step 3 is you make a higher high. Right here, we're higher than this. So this is somewhat of a first indication that things are improving. This is when your risk reward right here might actually be at its best. And notice when we break out here, that's a strong looking candlestick, and then a gap up. So that's a pretty convincing move to higher ground for inflation over deflation expectations. And the stock market did do well after that point. Before we close, let's talk a little bit about fundamentals. Europe is what matters. Earnings, U.S., not as important. Employment in the United States, not as important. This is what matters right now. Until this is cleared up, the yield on Italian debt, it's going to be very, very difficult for the markets to regain their footing and to get a flip from deflation ruling the day to inflation. Let's talk a little bit about deflation. Greece is basically defaulting on 50% of their debt, maybe 100%, but it's looking like it's going to be 50%. That's a deflationary event. You're destroying wealth. You're taking money out of the system. So as we purge debt, that's deflationary. And when you take on debt, that's inflationary. So when we went through all the bubbles and people were taking on debt, that causes asset inflation, price inflation. And when you go through the deleveraging process where people are defaulting, purging debt, paying off debt, that's deflationary. The concern here is this is the yield, so the interest rate on an Italian bond. It's over 6%. The benchmark, the safe bonds in Europe, are German bonds. It's under 2%. So what does this tell you? It tells you that participants in the marketplace roughly believe that the probability of default for Italian bonds is 300% greater than Germany defaulting. That is a huge, huge spread. And this signals there's a problem. So this is a threefold increase. And why does it tell you that? It says, look, I'm willing to loan you money, Italy, but you're more risky than Germany. So if I'm going to loan you money, you've got to compensate me for that extra risk by paying me a higher interest rate. And as far as Spain and Portugal went, once they went above 6% on these yields, things started to get a little dicey. So we're in very, very dicey territory here for Italian bonds. To put things in perspective, Greece is the 27th largest economy in the world. Italy is the 7th largest. France is the 5th largest. And France has got some problems, and France could lose their AAA rating. So I'd like to see this come down. Kind of in a perfect world, we'd see the previous charts of GLD and TLT spike up in a bullish manner, and we'd like to see this number come down as well. Why is this number a problem for Italy? Why it's a problem is they've got a gigantic debt burden. And as the interest increases on the debt burden, so your interest expense over time starts to become overwhelming at interest rates this high. So it's very, very difficult to service the debt when you have to pay a high interest rate, because then when you're selling bonds in the future and raising capital, a very, very high percentage of it goes just to pay interest rather than run the country and pay pensions and do the things that you need to do. The other concern about Europe right now, and another thing to watch, is most economists believe that Europe has slipped into a recession. And that makes people even more risk averse relative to Italian bonds. The numbers in Italy in terms of debt to GDP and things like that aren't as bad as you would suspect. The growth is just extremely low. So Italians as a nation don't have a debt problem as big as you would expect. The problem is the debt relative to GDP growth, and this interest is a problem. So the markets will struggle as long as this number remains high or if it goes higher. And the markets around the globe will also struggle as you see any negative economic news coming out of Europe. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.